ending the year on a high note. Futures are rallying on signs of trade optimism between Washington and Beijing. Over the weekend, well, on Saturday, President Trump tweeted that, quote, big progress is being made following his phone call with China's President Xi Jinping. But the potential breakthrough will likely provide little relief to investors as all three major indices remain on track for their worst year since the financial crisis. The Dow and S&P on pace to see their worst December. I told you, 1931. Anything for the left to remind people about the Great Depression. Joining me now, James Investment Research Chief Investment Officer Barry James. Barry, what is it going to take to set stocks on a positive path in 2019?
It's going to take probably sentiment changing and a solid economy rather than a worrisome economy. We think we're in transition. You know, I was there for the birth of my three kids, Matt, Alicia, and Alex, and my wife will tell you transition was the worst time. So we think we're going through a transition in our markets, going from these very expensive stocks more toward valuation-oriented stocks, companies with good earnings. This year, companies with no earnings were up over 30%. Companies with earnings didn't do anything. So that's going to be the change. And I think it's going to be exciting for most investors because they don't buy those companies without earnings. And so I really think that there's some great opportunities out there. And with the prices down a little bit, this is a good buying opportunity.
Barry, good morning. Mitch Rochelle. We talked at the top of the show about China being a big story, and that's likely going to be the case clearly into the first quarter because a deal's not really due until March 1st. But between now and then, we have earnings season. Is there any sectors that you're worried about from an earnings perspective in the fourth quarter that could really influence the market and its direction into 2019?
Yes, obviously, companies that are affected by the trade concerns that we have. Definitely that's one of the areas. So the industrial area and technology, which is really focused on international sales, may have a little bit rougher period of time. We're having a natural slowdown. We had 25% quarter after quarter in 2018 earnings gains. So we're going to see lower than that as we go into to 2019, and I think that's weighing on people's minds. And the whole thing with China is serious. It's not just a trade deal. Their industrial side is actually in contraction right now, and that's going to affect the whole world.
Yeah, indeed. We had the data that came out last night, the PMI going below 50, and it's the lowest in almost 3 years. Barry, you talked about transition earlier. Growth stocks until the recent sell-off really led the market for a very long time, most of it last year, most of this year, excuse me. I'm already on to 2019. So in 2019, on that note, are you looking for value to start outperforming growth here? Is that what I'm hearing from you?
Yes, it is. I mean, generally, going back to 1926, of all things, you find that growth does better about 4 years, and then it ends its cycle of outperforming value. We've gone over 11 years. In the last 3 years, it's been all high PE stocks and very expensive stocks. So we're seeing that shift, even this last quarter, where value is starting to hold up. Not that it's going up, but it's not going down as much. And we think that shift is coming, and it's going to come in full force. And we think it's going to be a really, really good year for more value-oriented types of stocks.
Maddie, you raised the issue of divided government, but is it possible that the lawmakers and even the president and the people who work for him can do more harm than good? Because I would argue, we're talking about trade and China and things like that, but really what kicked off this sell-off was interest rates went up too much and too quickly, and even the rates that the market controls. If this was all in lockstep with the 10-year going to almost 3.25. So again, are we going to get more jawboning about the Fed, more anger at the Fed, or actually action against the Fed? Because I think that that's one thing that people will be paying attention to out of D.C.
You know, I think markets are just desperately seeking certainty. So one of the difficulties in D.C. right now is that we have policymakers in the form of the administration and Congress really heavily talking about the Fed in a way that they haven't in the past. Markets don't know how to incorporate that kind of activity. They don't understand that kind of political pressure on what they see as, up until this point, probably an apolitical body. So I think that over the next couple of months, it'll be interesting to see how markets start to price in that sort of political pressure on a body that is supposed to be immune from that kind of rhetoric.
Yeah, and I would argue it's never been apolitical. We just didn't hear about it from the President of the United States or even see it on Twitter. So again,
that's exactly right.
Again, it's why anybody surprised that the president would say that.
And the big question for me moving forward is all the skeptics who say, especially if it's true what Barry's saying, that the earnings story is the one that's going to dictate growth in the market next year. What we do when the stimulus, quote-unquote stimulus, is running out. Now without tax cuts next year to guide business decisions, what does that mean for investors? I think that's the big question.
Well, the spotlight is going to be on initial public offerings next year. 2019 could be a record setter for the public markets as a number of unicorn companies gear up for their debuts. Big names including Uber, Lyft, Pinterest, WeWork, Airbnb, and Slack, all in the set to go public or in the pipeline. Barry, will this be able to happen? Because we've had Kathleen Smith on this program saying that the performance of IPOs lately in the last half of this year has been so lousy, it's possible that the market for IPOs is actually shut down, where companies just can't go public because there are no buyers there. What do you say?
It's going to be a real challenge, I think, because so many of these have no earnings. And as we've seen over and over again, IPOs generally are not good to own in the first year. Stay away from them. It's generally just like Facebook. If you'd have stayed away from it in the first year, you'd have been great and then bought it after things settled out. So there's a little bit too much hype. And one of the things we are seeing, though, is that companies, the people inside them are buying back shares, and that's a good thing. So they have some support for the market in that way. But I don't think that these unicorns are going to be, quite so rainbowy when they first come out this coming year.
If they come out at all. Barry, thank you so much for that, Barry James. And I'll point out, you would have saved a lot of money if you'd stayed away from Facebook in the last year. Of the tech titans, it's lost, well, almost 1/4 of its value in 2018.